So, medical expenses. You go to the doctor, you get injured, you go to the doctor, they put a cast on your arm, they charge you a boatload of money to fix up your arm, you get the bill. It is possible that the amount that you pay would be deductible as an itemized deduction. Now, there are limitations to this though. First limitation is you have to subtract out any insurance proceeds that were received. So for example, if you've got a medical plan, let me see the bigger this is. Better. If you've got medical insurance and you just have a copay for your doctor visit, maybe you only paid $10 for your copay and insurance picked up the rest, well, the amount of medical expense that you incurred is just that $10. You don't get to include the entire amount because the insurance company is who paid the remainder of it. So you have to adjust for any insurance payments that have been made. So it's only going to be the amount that you actually paid. It's only for individuals, the taxpayers, their spouse, and their dependents on that tax return. Now there is an exception for non-custodial parents. If they pay, if they're a non-custodial parent, it means that the child is not a dependent on their tax return. But if they are, if they have a non-custodial child and they pay medical expenses on their behalf, then those amounts would be deductible and included in that. But for the most part, it's taxpayer, spouse, and anybody who's listed on the tax return. Okay, so that is, so we got that qualifying. Oh no. What happened? Okay. Whew. So it has to be a qualifying individual that the expenses are being paid for. So if your Aunt Louise, who is not your dependent, breaks her arm and doesn't have any money and doesn't have any medical insurance and doesn't have any money, and because you're a really kind-hearted person, you go ahead and pay her medical bill, well, she doesn't meet one of those relationship qualifiers there. So it's just out of the goodness of your heart. And unfortunately, because she's an individual, that also doesn't count as a charitable contribution. So it truly is out of the goodness of your heart. You're not going to get any tax benefit out of that.
But could she get a benefit towards her income, or like towards her medical expenses for it?
Would she be able to take, well, what you'd want to do is give her the money and then have her pay it. But if she's that broke, she's probably not itemizing her deductions anyway, so that wouldn't happen that often. But that is possible. You could give a gift, which wouldn't be taxable either, and then they could, from that gift, they could pay it. The next limitation is an AGI limitation. So only the amount of medical expenses over and above 7.5% of adjusted gross income is deductible. That means, so if we've got AGI, we'll use $100,000 because that's really easy to calculate. We've got AGI of $100,000, and we've got medical expenses, qualifying medical expenses, deductible of $20,000. Well, that's 20% of our AGI. First thing we have to do is calculate what is 7.5% of our AGI. On that Schedule A, that's what the second line is there for. You're supposed to enter your AGI so that you can make this calculation. So 7.5%, 7,500 is our limit. This is the amount that we can claim, even though we had $20,000 of qualified medical expenses. So you can start to see how this can be really limiting. I will tell you, the majority of people who who benefit from the medical expense deduction are individuals in nursing homes. because they are paying an awful lot of money in those fees to nursing homes, assisted living, that sort of thing. So that is another one of the limitations. So I already talked about this. Dependent child of divorced parents is treated as a dependent of both parents. So here's a calculation you could use. You'd take your total medical expenses minus any insurance reimbursement to get the allowable net paid medical expenses, essentially whatever you wrote a check for or put on your credit card. If you put it on your credit card, that counts too. Just because you haven't paid your credit card yet doesn't matter. If you charged it, then it counts. Minus 7.5% of our adjusted gross income, so you're always going to take that AGI, multiply it by 7.5% to find our limitation. Now, obviously, if our medical expenses here were $6,000 and our AGI was $100,000, then we're going to take the $6,000, right? It's going to be whichever is less between those two, either 7.5% of AGI or the actual medical expenses, whichever is less. Okay. Oh, they like to use the 100,000 as well. I already did an example. We don't have to look at Alice and Bob. As far as the dependency exemption or whether somebody's a dependent, you don't have to look at the gross income and the joint return tests when you're determining whether or not, if you paid medical expenses for somebody and whether they're included as a dependent for purposes of the medical expense deduction, right? So if you pay the expenses of an individual who satisfies the relationship, citizenship, and support tests, then they would be included as a dependent for purposes of the medical expense deduction. They may not be a dependent on your tax return, but if you paid medical expenses on their account, then you would be able to deduct those medical expenses, subject to that 7.5% of adjusted gross income. So it's claimed for medical expenses actually paid during the year. Like I said, putting it on a credit card counts. So December 31st, you got a $3,000 bill from the hospital. You charge it. You're not going to have to pay that $3,000 until, I don't know, late January or maybe even February on your credit card, or maybe you're not even paying your credit card off every month. That's all right. That $3,000 is charged on December 31st. It is all included as a medical expense for purposes of the medical expense deduction. Does that make sense, everybody? Okay. So, what exactly is medical expense? This would be medical care for the diagnosis, cure, mitigation, treatment, or prevention of disease, or for the purpose of affecting any structure or function of the body. That is pretty broad, right? You can include a lot of things in that, really. Also, any transportation expenses that you incur in order to obtain that medical care. Qualified long-term care services, so that nursing home, assisted living, that sort of thing. Also, medical insurance. So insurance for medical care or qualified long-term care services. So if you have long-term care insurance, that is considered a deductible medical expense. Health insurance is also considered a deductible medical expense. So if you are not self-employed, remember, if you're self-employed and you have self-employment income and you pay out of pocket for your health insurance, you're probably better off taking that self-employed health insurance deduction, because that's a 4 AGI deduction, right? But if you can't do that, say you exceed, either one of those limitations that we talked about with regard to the self-employed health insurance deduction, where you can't, it's limited to your net income from self-employment, and you cannot qualify for health insurance or subsidized health insurance from an employer. So say you have self-employed health insurance, but you don't qualify for that deduction because you don't meet one of those tests, you could still deduct it as a medical expense. Now, again, it's gonna be limited to that 7.5% of your adjusted gross income, so you're not gonna get a deduction for all of it. And it is a from AGI deduction, not a for AGI deduction, so it's not going to reduce your AGI. But you can see when we're talking about that, those adjustments, think about this. So our AGI is $100,000. We're limited to 7.5%, so $7,500. Let's just say that we had income, we'll use that $100,000, but we had, think of some of these things. So we had student loan interest, $2,500, and we contributed to an HSA, so, and we contributed $3,000 to that. Maybe we had some self-employment income, and so 1/2 of that self-employment income was, I don't know, $2,500. All right, and those are our Schedule 1 adjustments for AGI. So now that brings our $100,000, 5/8 to $92,000, right? 7.5% of that. What's 7.5% of 92,000? Somebody do that for me. I should bring a calculator. But you all have calculators.
92,000 times what?
7.5%. And we'll back up to, we'll say this was 20,000. How much is it? 6,900?
Yep.
Okay. So before, our limit was 70, sorry. So the amount over, what am I doing here? AGI, 6,900. So in this case, actually, you want, no, the first amount, sorry, let's turn around here. So this is the amount that is not deductible, okay? Any amount over that would be deductible. So if we've got $20,000 of deductible medical expenses, and we have $100,000 AGI, then 12,500, I got that right? 12,500 would be deductible, because that's the amount that's over the 7.5%. If, however, we could bring our AGI down to $92,000 now, and we had $20,000 of medical expenses, now what do we have? 100, how much is that? 13,100? Do I have that right? 6,900 plus, yeah, is 20,000. Now, our deductible medical expenses have increased. So you can see how you not only get to reduce your taxable income here, now you also are gonna get to reduce your taxable income even more because of those 4 AGI deductions. Does that make sense? Just sort of an example of that, so. Now, so for the most part, it's pretty clear what a medical expense is and what a medical expense isn't, but there can be some cases where it's a little bit fuzzy. Expenditures for personal living and family purposes are generally not deductible if they're incidental to medical care. So think about this. So if you have, try and think of an example here. I can't think of one off the top of my head. Oh, okay. So your doctor says to you, you need to lose some weight. You need to get in shape. We need to fix this. And so he says, maybe you should get a gym membership. That is a personal expense. That is not a medical expense. The doctor, just because the doctor recommended it, doesn't mean that it is a medical expense. Now, if the doctor said, hey, there's a personal trainer who's also what do they call them, PT, physical therapy therapist, that is at this gym, I'm gonna give you a prescription, you need to go and see them in order to, your leg is in need of some rehab, that's a different story, okay? But just the general, hey, you need to lose some weight, go join a gym, which, by the way, exercise does very little for weight loss. But if that were the case, that would not be included as a medical expense. They did include a lot of the PPE stuff for COVID. They included things that ordinarily wouldn't be, like masks and stuff like that, or gloves and things like that wouldn't, for ordinary folks, if you're not in the medical field, wouldn't be deductible, but those were included as a result of COVID. So here's a good example. Physician prescribed special diet consisting of a low-fat, high-fiber foods to lower cholesterol. The physician's bill is definitely deductible, however, is the cost of the food a deductible medical expense? So in this case, it actually could be, but it's only the amount over and above what you would ordinarily be spending on food. The mere fact that a physician prescribes or recommends a course of action does not automatically qualify the expenditure as a deduction. If an expense item is ordinarily for personal purposes, the excess of the cost of the special items qualifies as a medical deduction. So the extra cost of a specially designed automobile over and above the normal cost of the automobile for a taxpayer confined to a wheelchair would qualify as a medical deduction, but not the entire automobile, okay? The food would be difficult to substantiate, and it would be difficult to quantify as well what the additional cost is there. So, taxpayers may not deduct expenditures that are merely for the benefit of the general health of the individual. For example, expenditures for cosmetic surgery are normally not deductible. Any payments made for operations or treatments for any part of the body or function of the body are deductible if they serve a distinct medical need. So for example, I decide I just don't like my nose anymore. I want to go get a nose job, or I'm so tired of these wrinkles that keep popping up, I'm just going to go and get a facelift. That's not deductible. If, however, I were in an automobile accident and was injured, and as part of that, my nose needs to be repaired. I doubt that I need a facelift as a result of an automobile accident, but my nose needs to be repaired. That is a different situation, right? There is a medical need, and it's to bring you back up in an attempt to bring you back to what previously were considered your old normal. Bring your new normal back up to your old normal. So this would also include payments to almost all healthcare providers, doctors, dentists, ophthalmologists, so eye doctors, also the eyeglasses as well, their prescription, nurses, physical therapists, as well as unconventional medical treatments, which would include acupuncture, treatments by Christian Science practitioners, also chiropractic. They don't have that in the list anymore because it's probably mostly considered traditional now. All right, capital expenditures. This is where you make some sort of change to a capital asset that you hold to accommodate a medical need that has been prescribed. So, this example here is a swimming pool. So, adding a swimming pool to your house. So if this pool is for primary medical care of the taxpayer, spouse, or their dependents, it could qualify for a deduction. So, for example, if somebody's got a medical condition that requires them to, I don't know, maybe a hot tub or some sort of therapy like that, but it's because of the medical condition, it could qualify. As it says here, this area has been highly litigated by the IRS. That means that a lot of lawsuits, the IRS has denied this many times to people, and then they've gone to court and argued with the IRS. And by the way, people win when they argue against the IRS. It's not, it's not a lost cause to take the IRS to court or to defend yourself if they take you to court. To ensure the deduction for the pool, the physician has to prescribe it. There can be no recreational element, no diving board or slide. All right. Other factors used in determining the deductibility would include the availability of other types of exercise and access to a community pool. So you can think of an example if somebody is out in the middle of nowhere and they need to have some type of water therapy, but getting to the nearest pool would be a 2-hour drive, and they're not really in any shape to drive. That could be enough to satisfy that medical necessity. Now, what part of it would be deductible? So the entire part wouldn't necessarily be deductible. The amount that would be deductible is the amount by which it increases the value of the capital asset. Or actually, I'm saying that backwards. It's the difference between, my words are getting mixed up, so I'll just read what they have here. So if the cost of a swimming pool for medical purposes was $30,000, the increase in the fair market value to the residents was $20,000, the medical deduction would be limited to $10,000. So it's the excess of the cost over the fair market value increase. So you install a pool at your house, it costs $30,000. You have an appraiser come out. Before you have the pool installed, they say your house is worth $200,000. And then you have the appraiser come out after the pool is installed. And they say that the increase in the value is only $20,000, so now your house is worth $220,000, but you spent $30,000 on it. $10,000 would then be deductible. The assumption there is that when you sell that house, you're going to get that $20,000 back, right? So you're not going to get a tax benefit for that part of it. So it's only the excess of the cost over the increase in fair market value. So here's an example. Surita suffers from a severe knee condition and is unable to climb steps. She installed an elevator in her home. Okay, like grannies and grandpas, they have those little elevators that take them up the stairs. That would be considered a medical expense. So she installed an elevator in her home at a cost of $7,000. An appraiser indicates that it increased the value of the home by $2,000. The cost of the elevator, $7,000, is a medical expense to the extent that it exceeds the increase in the value of $2,000. So $5,000, the difference between those two, would be what the medical expense deduction is. Now, in reality, that elevator probably doesn't increase the value of the house, right? And in fact, could very well decrease the value of the house. So you're not going to get more of a deduction than what you paid, but it's entirely possible that if it actually decreases the value of your house or doesn't do anything, then you get the entire amount would be a deductible expense. Let's see. Oh, we already talked about that. Insurance, again, we've got to subtract out insurance from that. Now, physician has to prescribe so this is for medicine and drugs. So the physician has to prescribe it. They give a couple of examples there. Also, and this is kind of interesting, so the taxpayer has to obtain the drug legally. Now this is interesting because they kind of changed the wording on this. It used to be that it could not violate any federal law, but the drug has to be obtained legally. Now we have a lot of medical marijuana. I think the majority of states have some sort of at least medical marijuana. Iowa's not one of those, but in the state it's legal, but at the federal level it is still not legal, right? So medical marijuana would not count because there's no way, as far as the federal government is concerned, for you to obtain that legally. So even if a physician prescribes an otherwise illegal drug, the cost of acquiring the illegal drug is not deductible. Also, so prescription drugs obtained from sources outside the US are deductible if they're prescribed by a physician for the treatment of a medical condition and the FDA has approved that they can be legally imported, okay? You can also, so now you can also use your HSA funds for that. So, but it does have to be an FDA approved treatment, which they don't approve everything. But anyway, so here we go. Physician prescribes marijuana for pain control purposes for a terminally ill cancer patient. The use of the marijuana for medical purposes is legal under the state law. Can a taxpayer deduct the cost of marijuana? Because marijuana cannot be legally procured under federal law, so that's controlling here. Now, you might be able to deduct it at the state level on your state income tax return. That's a possibility, if you're in a state where it's legal to obtain it. But at the federal level, it is not. So you cannot, it is not deductible. Travel and transportation expenses. So oftentimes, obviously, we have to drive to get to medical appointments, even if it's just in town, a couple of miles, but that is considered a deductible medical expense. If you have to drive to go get your, pick up your prescriptions at Hy-Vee or CVS or wherever, that the cost of that transportation would be considered a deductible medical expense. So for those individuals where they know they're going to be eligible to deduct those medical expenses, they know that they're going to itemize first off. So that's the first big hurdle, is you have to be able to itemize, which means that your total itemized deductions are greater than your standard deduction. So that's the first hurdle you have to get over. Then the second hurdle is those medical expenses, as long as they're qualified, have to exceed 7.5% of your adjusted gross income. If they don't, none of them are going to be deductible, right? But, or, you know, if they do exceed, it's only going to be the amount that's over and above that is deductible. But for those individuals who have determined that they are going to be able to meet those thresholds, then it is probably worth it for them to keep track of their mileage, because that's only going to increase the deduction, right? Cost of transportation must be primarily for and essential to deductible medical care. So it has to be in conjunction with something that is deductible. Driving to get your medical marijuana would not be considered a deductible expense, that transportation, because the medical care itself is not deductible. So here's an example. John Avery lives in New Orleans, has to fly to Memphis to see a specialist concerning an inner ear condition. His spouse is a big Elvis fan, decides to go along to visit Graceland. Travel costs for Jake, but not his spouse, are deductible as a medical expense. So because Jake is going there for medical care, but the spouse, none of that is deductible. If, on the other hand, his spouse's assistance is required on the trip due to problems stemming from the ear condition, the spouse's cost would be deductible. The cost of the ticket to Graceland would not be, but so you can have one assistant with you, one person to assist, and their costs would be considered deductible if they're there to assist, not just to come along for entertainment purposes.
How would you know?
How would you know? Well, that's something that if the IRS questioned you, you'd have to be able to substantiate it. Unfortunately, because it's mostly civil cases with the IRS, the burden is on you to prove that the deduction is valid. The burden is not on the IRS to prove that it's not valid. It's on you to prove that it is valid. So,
like, how would you make that point valid? Would you say they come home with you, they monitor you while they drive?
Yeah, I mean, if you have other experience where they have been assisting you, and other people know that they're assisting you. I mean, anything like that would help to substantiate the claim. If they've come to you, they come to you with you to all of your doctor's appointments, and the doctor knows that, and the staff there knows that, you know, that would be the type of thing that would substantiate it.
Cause my mom's like that. She's like, come with me.
Yeah.
And I'm like, why? I need your help. No.
Well, I mean, if she needs your help, then.
But she doesn't.
But she, okay, well, she wants the company.
Exactly.
So there are two ways to calculate transportation expenses, and you'll see that these are the same two ways that we use in the next chapter when we calculate business transportation expenses. We can use actual costs, or we can take a per mile deduction called the standard mileage allowance. So obviously with the actual costs, you would have to keep track of specific, you know, receipts and the cost of gas and and some of that stuff, if it's just, you know, occasional transportation, would be really hard to determine. Okay, so it was a gallon of gas that at $4.12 a gallon that I had to use. You know, that would be pretty specific. The other method, though, of doing that is the standard mileage allowance, which allots a certain amount to every mile that you drive. Now, with the standard mileage allowance, you don't have to keep the receipts, but you do have to keep track. You have to have like a log showing, you know, the date that you went, where you went, how many miles, your beginning odometer reading, your ending odometer reading, so that would be your substantiation. But they include here for actual cost, gasoline, oil, repairs that are directly associated with transportation to and from medical care. There's no deduction for general repairs, maintenance, or insurance in that case. So your oil changes or your car insurance don't count. So mileage allowance in 2022, and be careful because they may trip you up with this change in the mileage allowance. I don't know specifically if they do with any of your problems, but in 2022, for the first half of the year, it was 18 cents a mile. For the last half of the year, it was 22 cents a mile. So that means if you kept track of your medical mileage for the year, and remember, you really wouldn't need to do this if you know you're not going to itemize or you know you're not going to have enough medical expenses. But for those who know that they are going to take the medical expense deduction, then you might as well just throw as much in there as you can, right? So let's just say we had an individual who drove 2,500 miles from January through June, and another 3,000 miles. These are for medical purposes, okay? 3,000 miles from July to December. So for June, and this is for 2022. So 2,500 times 0.18 and 3,000 times 0.22. Somebody can do the math on that for me.
For the first one.
450?
Yeah.
That's 660. So your transportation deduction is $1,110. Now, that's an awful lot of mileage for medical purposes, but it's entirely possible, right? If you're going up to Mayo Clinic, like we go up to Mayo Clinic for medical purposes, or going to Iowa City, that sort of thing. If you are in the, let's just say you're in the 22% tax bracket, so that what's 22% of $1,110? You just saved at federal taxes $244.20 by claiming that mileage for your medical purposes. That doesn't count, if you have state income taxes, and you are allowed a deduction for medical expenses for state as well, right? So just kind of an illustration of how that can help out. Here we've got Maria, and this is an example of, they're comparing the actual expenses to the per mileage or per mile method. Maria has an inoperable brain tumor, requires treatment at the University Medical Center in Houston every month, that is done throughout the year, ratably throughout the year. Okay, so they say that ratably so that you know that it's every other month, so she went 3 times in the first half of the year, 3 times in the last half of the year. That's what the ratably means, equally throughout the year. It is a 500-mile round trip. She pays $10 in tolls, $20 in parking, $75 for gasoline on each round trip. Assuming she made the trip 6 times in the current year, what is the maximum transportation expense deduction for medical purposes using the mileage rates in effect? We're going to disregard that 7.5%. We'll assume she's already over that 7.5%. So, actual cost, what you would do, take the gas. She said it was $85. Why is that 85? And they say 75 up here. I think they made a mistake. Is 85, is that, maybe they meant to say, well, let's just pretend that's 85. Because, I mean, gas prices did go up. They probably just forgot to change it in the text. So $85 per tank, 6 trips, $510. Tolls, 6 times, $60. Parking, 6 times at $20, $120. So her total deduction is $690 for actual expenses. If, however, she uses the mileage rate, now, remember it was 500 miles, round trip, 500 times 18 cents, times 3 each. This is weird. Okay, so this times 3 plus this times 3. It's really weird how they wrote it here though. So each round trip was 500 miles. She made 6 round trips, 3 of them the first half of the year, 3 of them the second half of the year. Total deduction, I'll assume their math is right, of $600. And she gets to add as well the tolls and the parking here. She doesn't get to count the gas. That is assumed in the per mile rate. But additional costs like tolls and parking, she does get to add. So her total deduction in this case would be $780. This is the one she would want to use, right? Because it's going to give her the biggest benefit. So, in addition to mileage, cost of meals and lodging at the hospital or similar institution is deductible. Now what they're talking about here are meals that is served by the hospital, okay? So, not like meals outside of the hospital necessarily. Lodging near the related medical facility is deductible as long as no significant element of personal pleasure, recreation, or vacation is involved. So think about people who go up to Mayo Clinic to receive treatment for something. They may have to pay for lodging while they're there if they're not an inpatient. The meals, though, there would not be deductible if they're eating them outside of the hospital. If they're an inpatient, though, eating them in the hospital, then that would be considered deductible. You can also, the lodging expenditures, though, are limited to $50 for each night for each individual. Meals are not deductible. So $100 a night if it's 2 people, right? And it's a maximum of 2 people. You find me a hotel that's $100 a night, and I'll find you a hotel that's probably not very pleasant to stay in. But that's the limitation of the lodging expense. So an example, a parent traveling with a child, obviously the child needs the parent there, right? They can deduct up to $100 a night. Long-term care insurance. So long-term care services and long-term care insurance, and I think we're going to talk about insurance here in a minute. So long-term care services, medical, maintenance, and personal care services provided to a chronically ill individual pursuant to a plan of care prescribed by a licensed healthcare practitioner. Okay, so you're not just in there for kicks. I don't know that anybody that would just go to a nursing home for that, but, so nursing home deductibility or other long-term care institution costs, the amounts spent are deductible if the principal reason for the individual stay is medical care as opposed to enjoyment or convenience. So I guess you could think of a situation where, let's say you've got a married couple that is one of the individuals has Alzheimer's or something, and so they're in an assisted living facility, but the other spouse doesn't really have any health problems, but they're there to be with the other spouse, right? So they move in to be with the other spouse. There's no medical reason for that other spouse to be there. So in that case, their expenses would not be deductible, but the spouse who has Alzheimer's or dementia would be able to deduct those fees. Let's see. Oftentimes with assisted living too, or even independent living, the facilities will itemize what's actual medical expenses. Like for nursing homes, 100% of it is medical expense. But for those step down type of care, those places that offer step down type of care, maybe only a portion of it is actual medical expense and the rest is just a living, an apartment, and normal living expenses. And those normal living expenses are not deductible, but the medical part would be. Like I said, most facilities will break out the amounts that are considered medical versus the amounts that aren't considered medical. Let's see. Insurance. So premiums for health insurance, if you don't qualify for the self-employed health insurance deduction, premiums for health insurance would be included. So you can see where, health insurance is really expensive. It's entirely possible to pay $1,000, $2,000 a month for health insurance, especially if you're older, but you're not quite Medicare age. So in that case, that would increase your chances of being able to use that medical expense deduction. Medicare premiums as well are also deductible. So most Medicare recipients, well maybe not most, but a lot of Medicare recipients, depending upon their income, will be required to contribute a portion toward the Medicare premiums. Those amounts would be considered a deductible medical expense. Long-term care, there are actual limits to the amount of, and these are premiums that we're talking about, how much you pay in insurance, not benefits. And it depends upon your age. So if you are under 40, you can only deduct $450 per individual for long-term care insurance premiums. You can see it goes up as your age goes up. Those premiums also generally go up as your age goes up. All right. I think that the rest of this is Maria and Jose. Okay, so what happens when you get a insurance reimbursement? So let's just say in 2022, you had a major medical event and you have a high deductible on your health insurance and you don't have an HSA where you can get the funds from that to pay for it. But you paid, and again, 2022, you paid $15,000 in medical expenses, deductible medical expenses. You submitted the claim to insurance, but they denied it. So you had to pay for the medical expenses. So in 2022, you took a deduction for $15,000. Well, come to find out, the insurance company made a mistake, and they should have paid for it. So in 2023, you get a check, you receive, say $12,000 from the insurance company. You took a deduction up here, right? You didn't know you were gonna get this, but in 2023, you actually did get it. That would be then income in the following year. Okay, because it's, you got the tax benefit up here, even though maybe you weren't able to take all of it, right, because of that 7.5% medical expense deduction. So it would have to be included in income in the year it was received, to the extent of the tax benefit received in the prior year. So, let's see, what else do I wanna say here? That's medical expenses. That's a lot of information. Any questions? That's a big chunk, right?